Hey everybody, welcome back to the channel. Today we're talking about a topic that can make or break your Roth conversion strategy, how you actually pay the tax. Now you might be thinking, pay the tax? Isn't that obvious? You just send a check to the IRS. But when it comes to Roth conversions, there are actually 4 different ways you can pay, and each one has its pros and cons. If you don't plan carefully, you could end up triggering penalties, losing efficiency, or even bumping yourself into a higher tax bracket. So in this video, I'll break down the timing of income in the eyes of the IRS, including income from Roth conversions, the 4 different payment strategies, and which one may be the best for your situation. All right, let's dive in. Here's the first thing you need to know. Federal and state estimated tax payments are usually made in 4 equal installments: April 15th, June 15th, September 15th, and January 15th of the following year. Now here's the catch. A lot of people wait until December to do a Roth conversion because they want to wait and see what the income tax implications of doing so are. But if you do a Roth conversion in December, the IRS pretends that income was earned evenly throughout the year. So if you don't account for that, you could get hit with an underpayment penalty. Right now, that penalty is about 8% of the underpaid amount. That's why it's so important to understand the 4 different ways you can handle the tax and the pros and cons of each approach. Option number 1, pay the tax from cash or a taxable brokerage account. This is actually the most efficient method. Why? Because it allows the full conversion amount to move from IRA to Roth IRA. You're essentially using your least efficient dollars from a tax efficiency perspective to catapult 100% of the converted amount into the Roth IRA. For example, let's say you convert $100,000 and owe 25% tax. If you got $25,000 sitting in a taxable account, you use that to pay the IRS, and the full $100,000 makes it into your Roth IRA. Mathematically, that's the best way to build long-term tax-free growth. But once again, we have to remember the problem that stems from this approach. Because the IRS assumes this increased income was experienced evenly throughout the year, they'll be wondering why you didn't make quarterly tax payments accordingly. And that's where you'll receive that 8% under withholding penalty. This can be a huge surprise that Roth converters simply don't see coming. The solution is IRS Form 2210, Schedule A1. This form tells the IRS your income was uneven, and it can wipe out the penalty for the first 3 quarters. Now, a word of caution, Form 2210 A1 is complicated. You'll probably want a CPA or an enrolled agent to help you file it. Still, because this keeps the Roth conversion as mathematically sound as possible, it's usually the preferred option, especially if you're under age 59 and a half, because it's your only option. Option number 2, withhold the tax at the time of conversion. This one's straightforward. Instead of converting $100,000 and paying tax from outside, you just withhold $25,000 and move $75,000 into the Roth. The IRS counts withholding as if it happened evenly throughout the year, so there's no penalty risk and you don't need to file any extra forms. The downside, less money ends up in the Roth IRA. That means less tax-free growth over time. So it's simpler, but it's less efficient. And remember, if you're younger than 59 and a half, this isn't an option because of the 10% penalty on early distributions. Option number 3, make a second IRA distribution and withhold 100% for taxes. Here's how it works. You convert $100,000 into the Roth, then later in the year you take an IRA distribution of $33,333 and withhold 100% for taxes. At a 25% tax rate, you net $25,000 after tax, and that's just enough to pay the tax bill on that Roth conversion. Now, when might you adopt this approach? Maybe you don't have the cash on hand at the time you need to pay the tax, so you take this additional IRA distribution to pay the tax. But let's say that at some point within the next 60 days, you know you'll come up with the cash. You can pay that $33,333 right back into your IRA. But keep in mind, this does count as your one indirect IRA rollover per year. Also keep in mind, this option is only available once you reach age 59 and a half. Also, if you use this approach, be careful you don't bump up into a higher tax bracket, especially if it's a jump from the 24 to the dreaded 32% bracket. Option number 4, just pay estimated taxes as you go. Let's say you know you'll do a $100,000 conversion in December. That creates a $25,000 tax liability. You can simply pay an extra $6,250 each quarter throughout the year. That way, by year end, the IRS already has the full $25,000. No penalties, no extra forms. It's simple, but it requires discipline and planning. So let's wrap up. When you do a Roth conversion, the way you pay the tax matters just as much as the conversion itself. Option 1, pay from cash and file Form 2210A1. It's the most efficient, but requires paperwork. Option 2, withhold tax from the IRA upon conversion. It's simple, but less efficient, and remember, it only works if you're 59 and a half or older. Option 3, make a second distribution. It's a safety net, but can bump you into a higher bracket. This one only works if you're 59 and a half or older. And option number 4, pay estimated tax quarterly. This requires discipline, forethought, but also helps you avoid penalties cleanly along the way. At the end of the day, don't let taxes or penalties blindside your Roth conversion strategy. Work with a qualified advisor or CPA. Make sure you understand your brackets and choose the option that aligns best with your personal circumstances. Thanks for watching. If you found this helpful, hit like, subscribe, and share this with someone thinking about doing a Roth conversion. I'm David McKnight. Thanks for watching, and I'll see you on the next video.